Hello. Welcome to the State Income Tax Aspects and Effects to the Federal Tax Cut and Jobs Act of 2017. My name is Mark Hawkins. I'm a State and Local Tax Director working out of the Seattle, Washington office. Joining me today is John Clausen, who is a Director out of the Moss Adams office in Silicon Valley, California. I will be discussing the individual income tax aspects to federal tax reform, whereas John will be discussing the business tax aspects to the Tax Cuts and Jobs Act of 2017. To begin, it's important to note that the most important aspect to multi-state corporate income tax and individual income tax is how the states conform their tax systems to the Internal Revenue Code. All state corporate income taxes and most state individual income taxes adopt or otherwise have some conformity to the Internal Revenue Code in determining their own tax base. How the states tie back to the Internal Revenue Code, and importantly, when that state conformity occurs, is very important to determine the overall state income tax effect to federal tax legislation that's been enacted by Congress. In general, states adopt the Internal Revenue Code in one of two ways. The first method is for those states that adopt the Internal Revenue Code as amended. For these states, they automatically adopt whatever changes Congress enacts to the code unless they have already specifically decoupled from certain federal statutes. This is exemplified by the Colorado statute mentioned here, where Colorado adopts the Internal Revenue Code which is the IRC of 1986 as amended. These type of states are known as rolling conformity states, where the state just automatically rolls its conformity forward whenever Congress makes changes. Other states adopt the Internal Revenue Code as of a specific date. For example, under Idaho's adoption of the Internal Revenue Code, it conforms to the Internal Revenue Code as it was in place on January 1st of 2017. These states are commonly referred to as fixed date or static conformity states. This map shows a breakout of which states are rolling conformity states and which states are static conformity states, and which states don't fit neatly into either category. As we can see here, there are many static conformity states, including large states such as California, Texas, Florida, Georgia, Michigan, North Carolina, etc. These states are significant in that they do not automatically conform to the changes that Congress enacts, absent state-specific carve-outs regarding certain code sections. As you can also see here, many of the states that do adopt fixed conformity do routinely update their codes every 1 to 2 years. So it's reasonable to expect that in 2018, many of these fixed conformity states will update their codes to tie back to the Internal Revenue Code on a date on or after the date the Tax Cut and Jobs Act was enacted, which was December 22nd of 2017. States in blue are rolling conformity states, and these states should automatically conform to the Tax Cuts and Jobs Act of 2017 unless the state has specifically not adopted certain federal statutes, as we saw when bonus depreciation was first enacted back in the early 2000s. Where changes to federal tax law can be significant to states is the computation of what goes into the tax base, be it gross income, adjusted gross income, or federal taxable income. The definitions of these terms are contained in IRC Section 61, 62, and 63. Gross income under IRC Section 61 is the taxpayer's total income from whatever source derived. Where a congressional enactment related to gross income can affect the states is the exclusions to gross income, where Congress has specifically excluded certain items from the definition of gross income. which we would have seen with respect to the extraterritorial income exclusion that's now defunct under the former IRC Section 114. Adjusted gross income under IRC Section 62 is the taxpayer's federal gross income less the 20 or so deductions permitted under Section 62. AGI is significant in that it forms the initial starting point for many states' personal income tax calculations. As a result, any changes to IRC Section 62 can have a significant effect on the calculation of a state individual income tax base. Finally, federal taxable income under IRC Section 63 is the taxpayer's gross income less all deductions permitted under the income tax chapter of the IRC, which would include also the changes to federal adjusted gross income. Many state corporate tax regimes use federal taxable income as a starting point for the state tax calculation from a corporate tax perspective. And when Congress makes changes to federal taxable income, such as the elimination of deductions or the creation of new deductions or changing the criteria of these deductions, these, in contrast to changes to AGI, can have very significant impacts in the states as to the calculation of a corporate tax base, and in some states that use taxable income as the starting point for individual taxes. Now, notwithstanding these starting points, all states will require various additions and subtractions to federal income in determining the amount of state taxable income subject to the state rate. Now we'll go through some of the various changes that Congress made to individual income taxes and how those might impact state individual taxes as well. One of the most discussed changes to the federal individual income tax was the general lowering of income tax rates. However, because this change does not have anything to do with the calculation of federal income, there should not be any direct state impact to the lowering of federal tax rates. Another change involved the doubling of the standard deduction and eliminating the personal exemptions. These changes exemplify the significance of most states using IRC Section 62 adjusted gross income as a starting point rather than federal taxable income. The standard deduction and the personal exemptions are not items that affect adjusted gross income, and any federal changes that don't affect AGI will not have any impact in most states. For the states that, however, use federal taxable income as a starting point, changes to the standard deduction, which I believe was a doubling of the standard deduction, and the loss of personal exemptions will have a corresponding impact to the state tax calculation, if provided the state has updated its conformity to the Internal Revenue Code to comply with these federal changes. In addition to the increasing the standard deduction and the loss of personal exemptions, Congress enacted certain limitations related to itemized deductions. For example, Congress lowered the mortgage interest deduction to $750,000 on debt incurred after December 15th, 2017, from $1 million prior to that. It also suspended mortgage interest deductions on home equity indebtedness for tax years beginning after 12/31/2017. One that has gotten a lot of publicity has been the capping of the IRC Section 164 state and local tax deduction to only $10,000. And other changes include limiting personal casualty losses to federally declared disaster areas and repealing the miscellaneous itemized deductions that were subject to the 2% AGI floor. The important considerations to think of with respect to state income taxation is, does the state conform to the Internal Revenue Code as of December 22nd, 2017? If the state does not conform, has not updated its IRC conformity to this date, many of these changes would not have any impact to that particular state's income tax calculation. Now, this would not be an issue for those states that are what we refer to as rolling conformity states, because those states would have automatically adopted these federal changes. But for any state that has adopted the Internal Revenue Code as of, say, January 1st of 2016 or January 1st of 2017, because these dates precede the date of the enactment of the Tax Cut and Jobs Act, these changes would not have any automatic impact to those particular states. And it would be incumbent upon the state to update its conformity if they wanted to have these changes, these federal changes, impact their state code. Assuming that the state has updated its conformity to the Internal Revenue Code as of December 22nd of 2017, the next level of analysis is to identify whether or not these federal changes would have any impact to the calculation of the state tax base. For example, if a state does not use federal income net of itemized deductions as a starting point, then any federal changes to itemized deductions would not have any automatic impact from a state income tax perspective. But for those states that conform to the Internal Revenue Code as of December 22nd, 2017, and use or take into account federal itemized deductions in computing the state tax base, then possibly the changes to federal law can have an impact to the calculation of the state tax base. And at that point, it will be important for the state to decide whether or not they want to continue to conform to certain sections, or, as we've seen in many cases, decouple from certain sections. Or there are various instances where the state could even have modifications to whatever federal language that's out there, rather than doing a binary adopt or decouple approach. One example of this would relate to the changes to itemized deductions related to state income taxes. Many states, for many states that impose individual income taxes, the limitation to state and local income tax deductions to only $10,000 is not likely to have much of an impact, because many states have specifically decoupled from Section 164 as it relates to state and local taxes. In other words, many states already require an add back for state and local income taxes deducted on a federal return. So any limitation to that federal deduction should not have an impact in the calculation of the state taxable income base. Another important change was the enactment of a pass-through deduction, where individual taxpayers can deduct 20% of their domestic qualified business income from a partnership, S-corporation, or sole proprietorship. Now, this deduction is limited to the greater of 50% of the W-2 wages paid by the entity with respect to the trade or business, or the sum of the W-2 wages paid with respect to the business, plus 2.5% of the adjusted basis of all qualified property. Now, this limitation that I just mentioned does not apply to joint taxpayers with less than $315,000 of income, or single filers with less than $157,000 of income. Again, with the previous slide, the first consideration as to the state income tax impact or effect to this new pass-through deduction is whether or not the state has updated its conformity to the Internal Revenue Code. If it has not, then there wouldn't be any state tax issue with respect to this pass-through deduction. The state's conformity to the Internal Revenue Code would not include the new Section 199A that allows for this deduction. One thing that was very significant that Congress did in the Conference Committee was specifically denote that this deduction is not part of a taxpayer's adjusted gross income. This was significant because in the vast majority of states that impose individual income taxes use adjusted gross income as the starting point. And so for the pass-through deduction to not be part of AGI means that for those states that use AGI as a starting point, they don't have to consider the tax impact to this pass-through deduction unless the state were to affirmatively seek to include it. So many states out there that use AGI as the starting point, the pass-through deduction has no, enacted by Congress, has no impact to those codes. There is, however, a small minority of states that utilize federal taxable income or income net of itemized deductions as the starting point. And for those states that automatically conform to the Internal Revenue Code, these states could have to go into session and make changes to their conformity to various federal sections, or even specifically decouple from Section 199A in order to keep the state, in order to keep this pass-through deduction from lowering the tax base of a state taxpayer. Next, we'll move on to the business income tax effects of the Tax Cut and Jobs Act with John Clausen presenting.
Thank you, Mark. And as Mark introduced me, I'm John Clausen, a director here at Moss Adams in the state and local tax practice. And I'll be speaking about the business tax effects of the federal tax changes on state taxes. So probably the most notorious and well-publicized business income tax change for federal tax purposes is the lowering of the corporate tax rate for C corporations from 35% to a 21% tax rate. This will have no direct impact to state income tax returns, except for the states, there's only a few states that permit a deduction for federal income taxes. And there is, however, an indirect impact, which is that state income taxes now become a larger percent of the pie of total taxes that a company pays. With state income taxes mostly unchanged or unimpacted by this, and federal taxes going down a lot, state taxes will become a greater focus for corporations going forward. So as I go through the rest of these slides, the common theme will be, we're going to go through the major changes made by the federal tax legislation and talk about state conformity or the impact that of these changes with respect to each of these major changes on state taxes. And a common theme is going to be to look at, as Mark pointed out, how does the state conform to federal law? And the answer to that is going to largely impact how much these, or whether or not these federal changes have an impact on a particular state. And whether a state is conforming as of a particular date, or if it adopts federal changes automatically, obviously that's going to impact greatly the changes, whether or not these states adopt the federal changes. So the first one here is the Section 199 Domestic Production Activities Deduction. 30 states have already decoupled from this section. So for those states that have already enacted legislation to disallow or not adopt this deduction, the change to the federal tax change, the repeal of this deduction, has no impact on those states. However, for the states that were allowing the deduction up until this federal repeal, the important consideration is whether the state has updated its conformity to December 22nd of 2017 or a date thereafter. If a state has rolling conformity, then they will automatically repeal this deduction by adoption of any federal tax changes. However, if a state has a fixed date conformity and they had not disallowed this deduction previously, then the state would need to go and pass legislation to decouple from their adoption of the DPAD deduction in a prior, by conforming to the prior version of the code. The next significant federal change was with regard to like-kind exchanges and Internal Revenue Code Section 1031. Exchanges for personal property have been eliminated from the federal tax law. And so the state, again, the state concern is whether or not the state will conform to these federal changes by looking at whether or not it has rolling conformity or a fixed date. And if we determine after looking at conformity that the state will not automatically adopt these changes, then it's possible that for some states, like-kind exchanges for personal property could still be available. Going along, the next change is with regard to federal NOLs. NOL carrybacks now for federal law are largely disallowed, and the 20-year carryover is eliminated and replaced with an unlimited carry forward. Significantly for federal purposes, NOL usage will be capped at 80% of taxable income without regard to the NOL deduction. Again, need to look at whether the state will automatically conform through rolling conformity, or if the state will not automatically conform to this because it adopts a fixed date for conformity to the code. Another significant consideration is whether a state adopts line 30 or line 28 as a starting point, because line 30 is federal taxable income after deducting NOLs, and line 28 is before. So if a state adopts line 30, which would be after the federal NOL deduction, then unless it has a separate state modification, it would adopt the federal changes. The next significant federal change relates to bonus depreciation, or depreciation in general. A significant change is that 100% of new property acquired after September 27th of 2017 and before January 1st of 2023 will be allowed to be complete 100% deduction for that property. And an increase from 50% bonus depreciation in the 2017 tax year. Once again, the major consideration here is the date of conformity to the federal Internal Revenue Tax Code. Many states currently do not conform to bonus depreciation. For those states, similar to the DPAD, those states will not be impacted by this law because they have not adopted or they've decoupled from the bonus depreciation rules. We will potentially see greater conformity for IRC Section 179. Some states may adopt modifications for states that choose to decouple from the 179 changes. And lastly, a significant consideration for state tax purposes will be to track different basis for state versus federal tax. Another very significant change for businesses is with regard to the dividends received deduction, or DRD. Prior federal law afforded 100% DRD for 80% or more owned corporations, and an 80% DRD for 20% or greater owned corporations, and 70% DRD for less than 20% owned corporations. The Tax Cut and Job Act actually lowers the DRD, 80% DRD, to a 65% DRD, and the 70% DRD is lowered to a 50% DRD. Again, as with the rest of these changes, the significant consideration is going to be how the state conforms, and also the starting point for federal taxable income for states that adopt a federal taxable income as their starting point. Next up was a significant disallowance of interest expense to the extent that interest expense exceeds 30% of a taxpayer's adjusted taxable income for federal tax purposes. The state, again, the major consideration is the date of conformity and whether a state has rolling conformity or fixed date conformity. Rolling conformity, again, would automatically pick up the federal change. Many states wholly disallow interest expense for interest paid between related parties. And so to the extent that was the interest being disallowed for federal purposes, that would have been already disallowed for state purposes. So that wouldn't have, the federal change wouldn't have had an impact because that interest is already going to be disallowed. And similarly, if there's combined interest that's being eliminated as part of a unitary filing group for state purposes, that may be another situation where the interest wasn't being deducted for state purposes already without regard to the new federal law. Significantly as well, state conformity to 381 and 382 will need to be considered in applying the federal rules. Next up is again, this was a widely publicized and much talked about provision of the federal change is the treatment of foreign income and the deemed repatriation of foreign income that will occur for federal taxpayers that have controlled foreign corporations and foreign unrepatriated earnings for federal tax purposes. So the significant consideration here is that many states have a modification for federal subpart F income. However, the definition for state purposes may be a consideration, and this is going to play out as the year goes on, but if a state only allows for an exclusion of subpart F income, a question arises as to whether that's good enough to allow for a state subtraction of this repatriated income, because the repatriation does not technically fall within subpart F for purposes of the federal tax law. Another consideration here is California's inclusion of controlled foreign corporations in a water's edge group return filing. And it's Moss Adams' belief that California will not pick up the subpart F or this income as subpart F income, and that this will not impact the CFC inclusion rules for California water's edge purposes. So basically, whatever is picked up for federal purposes is going to have to get reversed out for California purposes because of nonconformity. Again, along similar lines, the anti-base erosion provisions of the new federal tax law require a U.S. shareholder of a controlled foreign corporation to include what's called global intangible low-taxed income. And there is a deduction of 50% of the amount included in gross income, and also a 37.5% deduction of a domestic corporation's so-called foreign-derived intangible income. These provisions largely will only be picked up by states with rolling conformity unless a state that has fixed conformity acts to adopt these provisions. The last bullet point on this slide mentions craft issues, which is, it's a good point that in situations where companies with foreign affiliates are taxed less favorably than companies that only have domestic affiliates, there's a foreign commerce clause of the U.S. Constitution issue that was an issue in the Kraft decision, an old state tax case that basically allowed for companies to have unitary filings, and that corrected the problem of companies being taxed differently that had foreign affiliates versus only those with domestic affiliates. So those same types of issues will come up when looking at the new federal tax law and how states adopt or do not adopt those provisions. So some key takeaways here is that the primary effect on multi-state income taxation rests with changes to federal adjusted gross income or federal taxable income. Changes to the rates do not impact the states. Another key with pretty much all of the changes I went through was that we need to look at whether a state has fixed date conformity or whether it has rolling conformity. And notwithstanding the general rolling conformity, there are a number of states that have decoupled from provisions such as bonus depreciation and the domestic production activities deduction. And basically the state issues around the repatriated income provisions and deemed income provisions are very complex and will require that we keep on top of it and look at the state-by-state guidance that we expect to come out over the course of the year. That wraps up our presentation. We thank you very much for listening, and if you have any questions, feel free to reach out to myself or to Mark Hawkins, and our contact information is here at the end of the slides. Thank you very much.